Harrison Forklift's pension expense includes a service cost of $15 million. Harrison began the year with a pension liability of $18 million, so they began in a underfunded pension plan situation. Okay, the requirement for Part 1 says prepare the appropriate general journal entries to record Harrison's pension expense in each of the following independent situations regarding the other components of pension expense. Okay, so the first case shows us that we had interest cost of $10 million, expected return on assets of $8 million, and amortization of net loss of $5 million. Alright, now I've worked this ahead of time just to speed up the demonstration. Let me slide this off the screen and we can see what we have. Okay, we have a service cost of $15 million given here in the problem. Okay, I'll put my mouse actually underneath it from now on so that you can see without the diagram there interfering with what you see. The interest cost, just to the left of my mouse now, $10 million, and that was given here. Okay, the expected return on assets reduces our pension expense, and that was the $8 million given there. There's no amortization of prior service cost to begin with, and the amortization of net loss is $5 million. So from that, what we do is we sum from above. Service cost of 15 plus interest cost of 10. We reduce the pension expense by the expected return we're expecting on the assets, and then the amortization of net loss again is a positive number showing the total pension amount equal to $22 million. Alright, let me move off this screen and we'll show you how you actually make that entry. And now you can see where all the numbers come from. So the 22 total pension expense gets debited. The $8 million of expected returns on the assets shows up as a debit to the plan assets. The projected benefit obligation is the sum of the service cost and the interest costs. And we are left with the amortization of the net loss, and the amortization of a net loss shows up as a credit of $5 million. Okay, now you see on the screen I've dropped in the changes that occurred in the second case of this problem. And basically we have interest cost of $10 million again, expected return on assets of $8 million again, but now we have an amortization of a net gain of $5 million rather than an amortization of net loss. So when we slide this off now, we can see that the service cost again is the $15 million plus the $10 million of the interest cost. Then we reduce out or subtract out the expected return on assets of $8 million, and we also subtract out the amortization of the net gain to derive at a pension expense of $12 million. So when I slide that off now, you see how that entry is made. And now the pension expense total is $12 million to the left of my mouse. Plan assets again increased by $8 million. We have a debit to amortize the net gain this time, and that's $5 million, which reduces the pension expense amount. And the projected benefit obligation is once again the sum of the service cost and the interest cost. Okay, and finally we take a look at the third situation, which you see here. Interest cost is still $10 million, expected return on assets $8 million, but now we have an amortization of net loss of $5 million and an amortization of prior service cost of $5 million. So if I slide this off, we'll see how we come up with the pension expense. We add in the service cost of $15 million and the interest cost of $10 million, but then we need to back off the expected return of the $8 million, but we have an amortization of prior service cost that increases it by $5 million and an amortization of net gain that also increases our pension expense. So the total of that is $27 million. And I'll slide that off and we'll show you how we make that entry. And here you see the $27 million is debited. The plan assets of $8 million again get increased. The projected benefit obligations are the sum of the service cost and interest cost, just as we've seen in the previous cases, so that equals $25 million. And now we have an amortization of the net loss and an amortization of prior service costs. Now both of these show up as -OCI, which stands for Other Comprehensive Income, because we need to reflect that in the Other Comprehensive Income area in our financial statements, not on the face of the income statement in the computation of net income, but it gets included in the computation of comprehensive income. And that's this problem, everyone.